In September 2020, a data analytics company called Palantir opened on the New York Stock Exchange at $10 per share. By the fall of 2022, it was trading below $7. Analysts called it a government contractor with a dying commercial story. Hedge funds shorted it, and the CNBC legacy media panels debated whether it would ever turn a profit. Alex Karp, the company's founder and CEO, was mocked for his eccentric shareholder letters and his refusal to play the Silicon Valley game. 3 years later, in November of 2025, Palantir closed at $207. That's a 17x return from the IPO, a 34x return for anyone who bought near the 2022 lows. An investor who put $10,000 into Palantir at $6 would have roughly $150,000 as of mid-April 2026. A $50,000 position in 2020 would now be approaching $650,000. I don't share this to make anyone feel bad about missing it. I share it because the signals were there. They were visible in the 10K filings. They were visible in the earnings transcripts. And they were visible to anyone willing to look past the noise. And the reason those signals matter is not because Palantir was unique. It's because those same signals, 5 of them, that specifically show up in every generational stock. Amazon in 2001, Monster Beverage in 2003, NVIDIA in 2016, and Tesla in 2019. The pattern repeats over and over again. And today, I want to walk you through those 5 signals. Then I'll give you a simple scoring framework you can apply to any stock in about 30 minutes. And then I will show you 2 companies trading today that check every single box. This isn't about promising you a 17x bagger. Many, if not most stocks that check these boxes won't return that. And some will fail entirely. It's the framework itself that matters. And once you know what to look for, you can evaluate the next big thing candidate with confidence instead of relying on a Reddit post or a podcast tip. Let's get into it. Here's how to actually apply each signal in under 10 minutes. The first signal is found in the stock's revenue inflection. Open the last 4 earnings releases and write down the year-over-year revenue growth rate for each quarter. Is the number going up? And if so, by how much? Did growth accelerate from 25 to 40% or from 55 to 70%? If so, then that's a 5 out of 5. If it's been flat at 30% for the past 4 quarters, then it's a 3. And if it's been decelerating, then it's a 1. Signal number 2 focuses on sticky customers. Control F, the latest 10K and earnings transcript for net retention or net dollar retention or net revenue retention. If the number is above 130%, then it's a 5. Anything from 120 to 130% is a 4. From 110 to 120%, it's a 3. Anything below 105%, and it's a 1 or 2. If the company doesn't disclose it, that's a yellow flag, meaning either the product isn't sticky or management doesn't want you to know. Signal number 3 is, does the founder have skin in the game? You can check the company proxy statement for insider ownership data. Is the CEO also a founder? And if so, what percentage of the company does management own? 25+% held by founder ownership is a 5. 10 to 25% is a 4, and 5 to 10% is a 3, and a founder or CEO with less than 1% ownership is a 1. Market expansion is signal 4. And here you can read the most recent shareholder letter and the first section of the 10K business. Is the company expanding from one market into a much larger adjacent one? And if so, is there actual revenue from the new market and not just promises? If the new market is 10 times the size of the old one, and they already have $100+ million of revenue from it, that's a 5. If on the other hand, it's just a roadmap, then that's a 2. Any change in the company narrative is the 5th signal. Here you can easily check on 3 things. The first one is the company approaching or hitting GAAP profitability. The next one is to check to see if the stock is on the path to index inclusion. And does it have a market cap above $15 billion, which is S&P 500 eligibility? Thirdly, has major sell-side coverage expanded in the last 12 months? All three of these checked off is a 5, while 1 to 2 is a 3, and none is a 1. That's the whole framework, completed in just 30 minutes of work. 5 scores and a clear verdict. Let me now apply it to the 2 companies I believe score highest in the current market. Let's dive into my 2 stock picks in the hunt for the next Palantir. My first pick is AST SpaceMobile, ticker ASTS. This company is building something that has never existed before, a satellite constellation that lets your existing, unmodified smartphone connect directly to space for voice, text, and broadband, without any new hardware, no special app, and no satellite phone. All you need is your regular smartphone, anywhere on Earth, on any existing carrier. If that sounds too ambitious to be real, I understand, as I was skeptical too. But the numbers have moved from promise to proven over the last 18 months, and the market is still pricing ASTS like it's a pre-revenue moonshot, and it isn't. The thesis on this stock is that the company is building the first and only commercially viable direct-to-smartphone satellite network, with over $1.2 billion in contracted revenue already secured. A zero-salary founder CEO who controls 75% of voting power and has never sold a share, and a market opportunity measured in tens of billions per year. The company is pre-profitable and pre-scale, which is exactly why it's still cheap. Execution risk is real, as satellites can fail and launches can slip, but the asymmetry is exceptional. And if you feel I've earned it so far, consider hitting the like button, subscribing to the channel, and sharing this video. That really helps the channel out, and it lets me know to make more content like this. Here is my pick number 2 for the next trillion-dollar company, Tempus AI, ticker TEM. Tempus AI is what Palantir would look like if it were built exclusively for healthcare. The company has assembled one of the largest proprietary libraries of multimodal clinical, genomic, imaging, and real-world patient data in the world. And it has built an AI platform that turns that data into something pharmaceutical companies and physicians will pay a lot of money to access. It is a rare company that is simultaneously a diagnostics lab, a data licensing business, and an AI platform, and all 3 segments are growing together. Like Palantir in 2022, Tempus is being dismissed by many investors as unprofitable and too expensive. Like Palantir in 2020, that dismissal is exactly what creates the opportunity. The thesis on this one is simple. Tempus AI has built a proprietary multimodal healthcare data platform with 126% net revenue retention, contracts with every major global pharmaceutical company, and a founder, who is also the CEO, who owns $2.7 billion of stock and started the company after his wife's cancer diagnosis. Revenue is growing at 83% a year. Adjusted EBITDA turns meaningfully positive in 2026. And the stock is trading at a 50+% discount to analyst consensus. This is Palantir in 2020. High conviction, the wrong kind of attention, and a clear trajectory. Now let's take a look at how to build these 2 positions. If I had a clean slate and was building a next Palantir basket today, here is how I would approach it. First, start with Tempus AI as the higher quality core position. It has the more mature financial profile, the more diversified customer base, and the clearer path to profitability. Target a 4 to 6% allocation to your portfolio. Second, layer in AST SpaceMobile as the higher asymmetry satellite position. It has the greater risk of failure and the greater potential upside if it works. In total, target 3 to 5% of the portfolio. Keep your combined exposure to these 2 names at 7 to 11% of the total equity portfolio. Do not let either one become more than 7% on its own, even after appreciation. Trim if they grow past that. Accumulate your positions over time, not all at once, as both stocks are volatile. Set your target entry zones and scale in over 3 to 6 months. Lastly, reassess every quarter against the 5 signals, and if any signal materially weakens, adjust the position. This is a framework, not a guarantee. Neither company is risk-free, and both can and will move 30% in a month at various points. If that bothers you, then these are likely not your stocks. But if you want to own what the next Palantir might look like, before the narrative shift, before the index inclusion, before the sell-side upgrades, then these are the 2 names at the top of my list. The hardest part of multi-bagger investing isn't finding the stocks, it's holding them. Palantir dropped more than 80% from its post-IPO high before it began the run to $207 in late 2025. An investor who bought in early 2021 had to sit on a 75% loss for 2 years before the stock ever recovered its cost basis. Most people sold during that period, while the ones who held are the ones who made 10x. Both ASTS and TEM will test your patience, and both will have quarters where the market decides the thesis is wrong. Both will have weeks where the stock drops 20% on no news. That is the price of admission, and if you can't hold through a 40% drawdown without panicking, size your position accordingly. A 2% position that you hold for 5 years will make you a lot more money than a 10% position you sell in a panic. In the hunt for the next trillion-dollar company, discipline is the whole game. But if you believe both the space-based telecommunications and AI healthcare machine learning industries are in their early days, it makes it a great way to get rich without getting lucky. And if you want to see what else I'm buying to get rich without getting lucky, consider checking out my next video. Thanks for watching, and until next time, this is the Invest Hunter. My name is Martin, reminding you that the best investment you can make is in you, and that you only need to be right one time to change your life.